Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us right now with SMBC Nikko Securities, Joe Lavorgna. For years on Wall Street, always with a vibrant message. Let's get the administration work basic. You were in the first Trump administration. Are you affiliated with the second Trump administration?
No. I do know the Treasury Secretary. I think is doing a great job, and you made a joke. He was perfect. I wasn't on any list. But my boss was Larry Kudlow. So Larry created a role for me in National Economic Council. That was Trump 1.0. So now I'm in the private sector.
Larry Kudlow and I are on the same page. This goes back to Wayne Angel, that nominal GDP really matters. Top line current GDP. Has this administration, with the chaos, whether Republican or Democrat, have they dampened the animal spirit? Have they dampened Kudlow's nominal GDP?
No, Tom. And I would argue that I'm going to give a counter narrative. And maybe it's that the chaos and confusion, which is the conventional wisdom, for now is actually not a bug of the system, but rather is a design so as to keep trading partners offside. If it continues, obviously, the full year, that's a problem. But I would say that what worries me much more on the uncertainty side is, what are we doing with tax policy? Because if we look at the uncertainty index, what we see is concerns about taxes are sky high. So we need the Congress to figure out, are these tax cuts getting extended? Are they not? Are there additional tax cuts? How might we pay for them? And that, to me, is a bigger concern for the economy and what it means for CapEx, ultimately growth, and then nominal activity.
Seems like every company conference call I listen to, every guest we have in here, we have roughly 25 a day, don't cite tax policy.
We have how many guests?
They say the uncertainty, when you do 5 hours, you get a lot. The
25
uncertainty
guests
just
you have?
Introduced into the system has simply been, we just don't know where the tariff policy is going to be. You tell us where the roadmap is. Companies will adjust. Tom likes to say that companies adjust. Investors will adjust. It just gives a little bit of a sense here. So we understand the chaos from a negotiating perspective. That's fine. That is a strategy. But boy, it seems like the market's really craving certainty around
it does.
Tariffs.
And I remember reading a book way back when by Michael Jensen, Harvard Business Review, and talked about the short-termism of U.S. corporate America. And maybe there's a little bit of that now where people want certainty. They're not going to get it. But also, CEOs tend to be pretty opportunistic, and you're buying a free option. So if anything goes wrong, and by the way, the economy, we could debate about the economic outlook. You could just blame whatever is convenient. So there's probably part of that. If you look at the small business side, that generates 40% of the jobs, their numbers look great. So I'm going to push back a little bit on that. Let's see how we go after April 2nd and what happens as we move toward June.
Are you modeling sub 2% real GDP? We weren't doing that pre-election, were we?
So here's the thing, Tom. I don't like the first quarter numbers. They're going to look soft. Because the expenditure side,
which has happened before, to cut everybody some slack, that's not unusual.
But what's really bizarre is that if you look at like real income, at least through January, it's up almost 3%. So you have like the expenditure side from Atlanta Fed down about 2%. And you got this huge increase on the real income side because job growth is still positive. I'm not sure how to square the circle. Right now, yes, it does look like GDP will be on the lower side than the higher side. You're supposed to mark your numbers down for the year, but having done this for a while, we also know that you could drive a truck through the first and last estimates of GDP.
Fair. But, given trickle-down economics, where's the Gini coefficient of the United States? I mean, is this an administration governing with a presumed tax cut for the haves against half of America flat on their back? Yeah,
so this is where I would say that where the Tax Cuts and Jobs Act, TICJA, which, by the way, President Trump wanted to call it the Cut Act. TICJA. So I like the former more. But anyway, but if you look at the data through the pandemic, and Kevin Hassett, our current head of NEC, Larry's old job, had done some nice work on this as well. But if you look at the income by quintile, the mid to lower ends in relative terms did extraordinarily well under Trump 1.0. And in terms of real median income was up about $6,000 in those first 3 years. And that was about 5 to 6 times what it had been in the prior 16 years with both Democrats and Republicans. So if the tax cuts, my opinion is the tax cuts are extended, you'll get that blue-collar boom that Larry, my old boss, talked about, and I'm optimistic we'll have good wage growth. But we'll see what happens. We need to get this done.
I mean, judging just from your sources, people you talk to, do you think that tax cut will be extended?
I do think it's extended. So one of the things I thought was interesting is when Speaker Johnson got that budget blueprint through, I thought that was a big deal because that told me we're going to get the CR. Right. So the fact we didn't shut the government, I think it was smart that Chuck Schumer kept the government open because that would have delayed things another several weeks. Depends is can we get a bill in place sometime maybe before June that it could be signed mid-year. That would make me more optimistic that we'll get good growth. If we're waiting, and I think, by the way, we'll get the tax bill done, but if it happens in December, I'm going to lower my GDP numbers.
Joe Lavorgna with us. Joseph Lavorgna, SMBC Nikko Securities, an extended conversation this morning. Good morning on your commute across the nation. Good morning, 99.1 FM in Washington, 92.9 FM in Boston. Of course, good morning on YouTube. Subscribe to Bloomberg Podcast. Just stunned at the results there. Good morning to all of you. Good evening, I should say, in the Pacific Rim. Paul?
Joe, from your perspective, what are the long-term gains that we may see in this economy for what may be some short-term pain? What are the long-term gains that you're looking for?
It's clear that we can't sustain 6% budget deficit to GDP ratios. And fortunately, whoever party in power always blames the other side for not being a fiscal hawk. But it seems like we certainly need to do something on the spending side. And what I've highlighted to clients is if you look over the years, the GAO has done some interesting work about how we do have a lot of waste, abuse, and fraud in the system. The Pentagon's paying $600 for a hammer. There are massive cost overruns for the F-35. By the way, any politician typically wants something done that can never be touched. It goes under procurement because we could always argue it's national defense. So that spending doesn't get touched. But GAO had said that anywhere from 100 to 300 billion we could get rid of per annum. Now, I've heard people think Elon Musk gave a higher number. I don't know if that could be the case, but at least the older stuff said, look, if it's 100 to 300 per year, over 10 years, it's 1 to 3 trillion. So that to me is meaningful, but we'll see. I'd like to, again, this comes back to the budget because I want things that are legislated because if it's legislated, you can't undo it every 4 years.
Okay, but this administration has quieted the legislature, right? I mean, the legislature's out of play.
Well,
right now we got an executive branch and a judiciary chasing after them.
That's right, Tom, and that's why we kind of need to figure out, okay, we haven't really legislated a lot. We've done a lot of executive order. That's why I'm relying may not be the right word, but I'm assuming that there's going to be something codified in law in the House.
Okay, totally. Lavorgna driving the market higher now. Futures up 70. Joe Lavorgna, and this is totally unfair to you because you're not at 1600 Pennsylvania or those environs right now. You say we need a tax cut. Brilliant. Who listening or watching says we don't need a tax cut? The line is tariffs will pay for it? Good morning, Canada and Mexico. Yeah. Explain this.
Okay. So I'm making the assumption there will be some minimal level of tariff.
Fair.
And I don't know what the numbers are going to be. Hopefully we'll know a little bit more April 2nd. My gut is that it'll extend a little bit further than there. We'll get some clarity, but not everything we want. Again, I don't know what they're doing in terms of the the spending cuts, and I don't know what the tariffs will be. I mean, there's roughly $3 trillion of imports, so a 10% tariff, in theory, could raise $300 billion, at least in the early years. But I don't know what they're going to do with that. It's certainly not going to be legislated in all likelihood, but is there a tariff? What is it? How many spending cuts are actually implemented? And how does the economy perform?
Have you seen legit work on this from Yale Budget Lab or CBO or from
the
Dr.
CBO?
Hassett?
Well, let me say this. I don't like the CBO scoring because if you look at, they assume in the next, just to give you an idea, over a 10-year scoring period, the difference between, using their revenue numbers, a difference between a 3% economy and a 1.8% economy over a 10-year period is about $4.3 trillion of additional revenue. So this notion CBO is going along this current law versus baseline, to me, is a big problem. And you're going to get a huge tax hike next year if it's not extended. To assume then your revenue share of GDP is going to go up, I think, is totally misplaced. So there's a lot of things that are going on, but I think the scoring has been woefully inadequate. But again, Tom, until we see what's in these bills, I'm just speculating. I want to see actually what happens, then I'll make a judgment call at that point.
The most recent University of Michigan survey was disappointing to the marketplace in the sense that it reflected slower growth outlook and higher inflation outlook. How concerned are you about inflation moving higher, whether it's driven by tariffs or not. What is your inflation call?
So the inflation, what I am optimistic is you are seeing money supply, and it's hard to measure totally broad credit creation. A lot of credit now is outside the public markets or in the private credit markets. Yep. M2 growth has slowed. You are seeing wage growth moderate, although I'm not a big proponent that wages drive inflation. Gas prices are dropping in some parts of the country. The energy side, to me, is going to be very important. And if the administration is successful, and I think they will be, but they need, one of my assumptions is they need gasoline and oil prices down, because you could lose about a point on inflation, headline and core, if oil goes back to 60 or slightly below. So we need that. So that's how I see things shaping up.
What do you say to people who say tariffs are a tax on the consumer?
So what I would say is when you go through just the simple math of what President Trump had said last year, 10% across the board, 60% on China, you got like a 9/10 increase in the price level, assuming everything was passed through, which history suggests it's not. Some will be absorbed in the margin, some will be absorbed in the exchange rate. But I would say to people, look, if you're having to pay a one-off higher price for a good, but if you're a blue-collar worker, you have no tax on tips, no tax on overtime, which, by the way, those are supply-side factors, and you're paying no tax on Social Security benefits, and we're also having the benefit of low marginal rates and low corporate rates. That, to me, is a great trade-off, because ultimately, in my opinion, it will drive long-term productivity growth through capital expenditure.
Thank you so much out on YouTube for this idea of what our government does, and I adored him. Admiral Zumwalt was one of my heroes a million years ago. So we spent $24 billion or whatever, $9 billion of research costs on the Zumwalt destroyer. We went from X amount down to 7. It cost so much, it was a failure. Now we're back to Arleigh Burke. I think Stavridis would say that's a good thing. Only 14% of the budget is controllable. What would be the proper response of the parties against President Trump? Do you see a cogent response to the Trump economics?
I'm not sure. Are you asking a question on the spending? I'm confused on the question.
It can be either. I'm confused on the moment as well. The confusion here is I don't see a cogent debate about our fiscal policy over into what it means for our family's investment policies as well. Where's this debate in 3 months or 6 months?
So let me just sidetrack for a minute. Let's just talk about Trumponomics. So what I see is, this isn't exactly what you asked, but at least we'll talk about the economic policy, is what I see is a desire and intent to re-engineer, reindustrialize the U.S. manufacturing base. And a tariff is a necessary but not sufficient criterion to try to do that.
Fair.
In addition to low corporate rates on domestic production, cheap and abundant energy, because it's very key to produce things. Germany isn't cost efficient anymore. If you exclude the pandemic production, their industrial production is back to what it was in 2010. Right. And then, of course, you need business-friendly regulation. Permitting process, I think, needs to change a bit. Even I think the other side can agree on that. So that would kind of encourage capital to come into the U.S. On the fiscal side, Tom, which you raised, which is very interesting, we need to have that debate. But I don't think we've ever realized how much spending we just waste. And people talk about, it's all entitlements, and that's where the money is, 30% discretionary. But there is a lot of waste and abuse, even on some of these entitlement programs. But people, unfortunately, conflate getting rid of the abuse with, people are losing their service. And that's not the case. But we don't have that debate, and we should.
We have a debate here that we haven't talked about, basic economics. Where does SMBC Nikko see the unemployment rate going, given all this?
We've got the rate essentially in the low 4s, 4 to 4.25. So we think it'll stay pretty low.
It's going to stay there.
Yeah, well, it's 4.1 now, and I would say
that's an outlier call, I would suggest.
To tell you the truth, that doesn't surprise us. We tend not to look at other economists, in part because we don't want to be biased. But to get a higher rate, Tom, we'd have to be really pessimistic on growth. Also, too, Okun's law is useful, which is, you know what Okun's law is, but it's the relationship between potential GDP and what actually happens in the economy. And the other thing is this, is that even if we had a slow period of growth this year, maybe you talked earlier about the pain. Yes, we're going to have somewhat of a pullback on the fiscal side. Secretary Bessent mentioned detox. But if all of a sudden it looks like 2026 is going to accelerate, financial conditions will ease in anticipation of that. Hopefully there'll be some clarity on the tax side, and companies wouldn't lay people off. So there'd be no reason for the unemployment rate to rise if the 12-month forward was improving.
Joe, thank you so much. Huge response.
Thank you, guys.
Thank you. Thank you. Joe Lavorgna, Chief Economist, SMBC Nikko Securities of Swarming, formerly working with Mr. Kudlow with the Trump administration version 1.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Without question, our equity discussion of Monday, maybe dare I say of the week as well, Ann Sonders joins us now with Charles Schwab. Ann, card to rule. I got to be in the game even when I'm stressed. Going to cash is a tough track record. How do you stay in the game given the cross currents of March of 2025?
So I think within the equity space, staying factor focused. As you know, Tom, we have been very factor biased and oriented over the last couple of years, feeling like the monolithic sector calls are much more difficult to do. There's much more volatility on a week-to-week basis at the sector level, a little more consistency in terms of performance at the factor level. And one of the factors that we added to our focus list as we headed into this year was low volatility. For obvious reasons, you wanted to have a little bit of that protection with that low volatility factor. And that's been the best performing factor. You guys track it at Bloomberg over the past 3 months or so. So I think the best way to navigate is a little bit more defense, but not in the traditional defensive sectors, doing it via the factor level.
Ann, I think one of the concerns out there in the marketplace is people are starting to question this economy. If in fact some of these tariffs come in, it could spell economic growth concerns. It could spell inflation concerns, and that calls into question kind of the overall health of the economy. How material is that risk? Because that would go to the earnings story.
Oh, absolutely. I think right now, if you look at betting odds, if you look at a consensus of economists, you're somewhere in the 30-ish% probability of recession. But that's a completely moving target as a result of the nature of this uncertainty and the way we get tariff announcements, not to mention back and forth pauses, retaliations. But I think if we go to the extreme on the tariff front, it raises recession risk, not just in the United States, everywhere. And even if we were to have more resilience from a trade perspective, because as a country we're less trade dependent, if you started to see more weakness show up globally, that obviously filters through to the United States. So it's not a better than even bet at this point for recession, but I think we all need to be dusting off recession watch list to reflect this incredible amount of uncertainty. We're not seeing a huge impact yet on the hard data. We're seeing it obviously in the soft data.
Yep.
But at this point, unless we get a reprieve on tariffs, what's more likely to happen, unlike a couple of years ago, is the hard data is more likely to catch down to the soft data versus the other way around.
We've at the peak to trough, we did have a 10% pullback in the S&P 500. We've rallied a few percentage points here, including the futures market today. How was that market move with a little bit of hindsight here? Was that a reasonable response to this uncertainty that's been brought into the discussion?
Probably, but I think the fuller story gets told under the surface of the indexes. You're right. In the terms of the S&P 500, maximum drawdown has been 10% this year. But if you look at the average member level, the maximum drawdown has been 15%. If you go down to the NASDAQ and you look at average member maximum drawdown year to date, it's negative 33%. So there's been a lot of churn and weakness under the surface. We still have a large cap bias in terms of what has been leading from a broad style perspective this year. It's just been large cap value, not large cap growth. That still gives a lift to these cap weighted indexes in relative terms.
You and your team live on airplanes and out seeing the Schwab world. When somebody asks the question from the cheap seats, Ann Sonders, is the bull market over? Let me rephrase. Is the bull market broken?
No, but I think we are clearly in a correction phase. It wouldn't surprise me if we continue this with this trade uncertainty, and in particular, if the tariffs do go into full effect on April 2nd, that we could have a cyclical bear market. I'm not sure I would yet be at the point of stating that if the bull market is over, that we're entering into some sort of secular bear market, but we're in a cyclical pullback here, notwithstanding some strength today. So I think that there is still risk related to the uncertainty regarding tariffs.
Liz Ann Sonders, with just all the experience she has at Charles Schwab, so that she's with us for an extended conversation today. Good morning across America. Good noon in Europe. On the Pacific Rim, we say good evening to all of you. Just humbled by the success out on YouTube of Bloomberg Podcast. Subscribe to Bloomberg Podcast. Paul?
Listen, I was just looking at some of the leading tech stocks that we've all grown accustomed to seeing moving higher and higher, whether it's Google or, Amazon or Microsoft. And, peak to trough, they're down 15 to 20% here. How do we think about the tech sector as potentially a leader for this market, which it's been for many, 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 many years? Can we still rely on that?
I think you'd have to see stability in forward estimates, whether it's the Magnificent Seven or it's the tech sector or maybe the growth trio that houses the Magnificent Seven, which would be tech, communication services, and consumer discretionary. We still have stronger earnings growth expected for, say, the Magnificent Seven cohort relative to the S&P 493, the other stocks within the S&P. The problem is direction. Directionally, we're moving up a little bit in terms of ex-Magnificent Seven. We're moving down, such by the end of the year, we're going to be not full convergence, but and this is based on consensus numbers. You've got Magnificent Seven looking at maybe 20% earnings growth versus mid-teens for the rest of the S&P 500. And that is in contrast to a year ago where the Magnificent Seven had about 55% earnings growth and the rest of the S&P was very low single digits. So it's the direction, it's the direction of travel that matters. And I think that's been one of the fundamental reasons why we've seen that group of stocks lag this year.
What's your confidence level, Liz Ann, in terms of the rest of the market, that low to mid-teens kind of earnings growth? What's your confidence in that earnings number? Do analysts need to bring those down?
Not terribly high.
Okay.
Not terribly high. I think analysts are at the mercy of the guidance that they're getting from companies. Companies are dealing with the grave uncertainty, basically going into hold pattern from a CapEx perspective, from a forward guidance perspective. It's not quite like it was back in the COVID era, where you saw a record percentage of companies just withdraw guidance altogether. But it's such a murky environment. And what analysts have done is take that sort of collective wisdom from their companies, and their bias has been to pare back estimates. Right. So you've gone from, at the beginning of the year, about a 15% expected growth rate for 2025. And this is all the entire S&P 500. That's down now to around 10%, which, if that is accurate, that comes in at a lower growth rate than 2024. I think that's been at play in terms of this corrective phase.
Where the multiple valuation, like you say, stay with large cap, but are we under a 20 multiple in a blended Liz Ann Sonders market?
So you have to segment it. You're still in the mid to high 20s for tech or the Magnificent Seven. Then you get closer to 20. We've come down from about a 22 forward multiple to about 20. Then you can go equal weight or S&P X Mag 7, and you're into the teens there. So it really depends on how you segment things. The problem is that we've had a declining numerator and a declining denominator. As I mentioned, I think we need to see stability in the denominator part of the equation to provide a little bit of a lift from a valuation perspective. We're not quite there yet.
I can't emphasize, folks, the partial dynamics Liz Ann Sonders just effortlessly described there. So take it further, Liz Ann. I got a better valuation in Europe. Warren Buffett is buying in Japan because he's got a better valuation there. Can you, just as a general statement, a PE ratio, can you be a PE hog and underbuy going to a lower ratio that's not going to lift when we lift?
So I think the international comp is an important one, because clearly we have seen the rest of the world trade at a significant discount to what have been fairly lofty valuations in the U.S. And I think that's part of the reason for international outperformance. It's a reminder to investors that even if U.S. exceptionalism isn't dying here, that there are merits to diversification across asset classes, inclusive of international, and that's clearly paid dividends. But one of the things we always like to remind folks is when you're comparing a region to a region or a country to a country, U.S. versus any place else in the world, you have to understand the economic dynamics of the country or region. If you are a country, say like Australia, that has a big mining component, the multiple afforded to that market in general is going to be lower than a more innovation-driven economy like in the United States. You know, my colleague Jeff Kleintop, who you guys know is our international strategist, talks about Germany is essentially an auto ETF. So I think there has to be that understanding of the economic dynamics, not just an apples to apples valuation comparison that needs to come into play.
Do you agree with my core theme? I think everybody knows I feel this way, that the great unspoken is corporations adapt and adjust. Can Standard & Poor's 500 corporations adapt and adjust to what they've been given in 2025?
Well, tell them what they've been given. So a colleague of mine was at the Business Roundtable in DC, and one of the themes coming from companies specific to tariffs was just tell us what they're going to be, and then we can adapt and adjust. But the back and forth, the shoot from the hip, the uncertainty in terms of timing, magnitude, duration is what's causing such a constraint right now. If we actually knew what the playing field looked like, I think companies absolutely could adapt and adjust. We're just not there yet.
So, Lizanne, giving all that uncertainty as a backdrop, is there any argument for small and mid-cap stocks here today, or no?
So I think there's some bottom fishing that is probably warranted, but I think more important, particularly important in the small cap space, is to stay up in quality. So focus on things like strength of balance sheet, the non-zombie companies, strong free cash flow, high interest coverage, profit margin stability. That's the way I think to move down into the small cap space. I wouldn't take an index approach to small caps, especially in an index like the Russell 2000, because we're still talking about at least 40% of the stocks in the Russell 2000 are some combination of zombie companies or not profitable. There are times where you get that leverage to a big turn up in the economy by going down the quality spectrum, and that tends to work in small caps. I think we're still far away from the point where we can start to build in an expectation of a huge pivot back higher in economic growth. Right. I think we have to wait for that for broader small cap outperformance. But I think that there are opportunities in the higher quality segments of the small cap indexes.
Just brilliant. We'll feature Ann Sonders in Single Best Idea today. Thank you so much, Ann Sonders at Charles Schwab. Really appreciate this morning.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Lots to talk about this morning. Busy morning. Futures up 67. Nice lift to the market. And some of that's because of our political news flow here in America. Henrietta Tresh joins. She's at Veda Partners. We've really enjoyed her valuable briefs twice a week here. Henrietta, I guess we're up because we're going to get tariff light. Is it as simple as that?
I probably, the interpretation, the headline reads as tariff light. I think if you dig underneath the surface, you'll see that it's still tariff really heavy. We have 20% new tariffs on $500 billion worth of goods coming in from China already. Those are going to rise to higher rates. They go on top of the Section 301 tariffs that are been in place for 7 years. So we're already up in the nearly 50% range. That should tick higher on all goods coming in from China. And you can say that story across the globe as well. With Canada and Mexico, I expect EU auto tariffs around April 2nd, new investigations. So there's a lot to come.
Are Republicans pushing back against, as a general statement, the White House? I see percolations of that. But do you see Congress animals pushing back against the Trump administration?
No, not at all. I was just on the Hill with a whole host of Republicans from all different states, Tennessee, North Carolina, Arkansas, and the response function is basically to diminish the severity of the tariffs and then talk about how they might be short-lived. Because the senators and lawmakers don't have information from the White House, they don't have a sense of what's coming any more than the street does, because so much of this is a moving target and being crafted at the White House without their input, and in many cases directly against what they would like to see. What you see the members doing is really downplaying the import of these tariffs. So there's a widespread view, for example, that it's just the uncertainty around the tariffs, not the tariffs themselves that are the problem. And then it really delineates between states. Do you have a lot of union members in your state? If so, maybe you're kind of supportive of the tariffs. Do you have a lot of manufacturers in your state? Then maybe you're supportive of the tariffs. So it really ranges, but I don't see any material pushback from Republicans at all. No.
Well, how about the Democrats? I'm not even sure we know who the voice of the Democratic Party is here.
Henrietta Traces.
Yeah, I don't know. Chuck Schumer, I don't know. Much less seeing a coherent countermeasures from the Democrats. Where is this party?
Democrats are absolutely nowhere. So it's also in with Democratic leadership over the last week. And what's exactly the problem is the same things on the Republican side. Because President Trump's agenda is more populist, there are some Democrats who support the tariffs. Bernie Sanders, for example, is going to support some of these tariffs. And senators or congressmen from the heavy union states in the Rust Belt are going to be supportive of the tariffs. So the Democratic Party can't find a message around how to demonstrate that 25% tariffs on aluminum directly translates to every bottle of beer that you're buying. They cannot also get their caucus united and in line to say, hey, we don't like these taxes on Americans that are coming. We don't support using current policy baseline to blow out the deficit. They're nowhere.
Henrietta, this came up this weekend over a beverage of my choice. I'm going to try to keep politics out of it. Henrietta Trace, is there any indication whatsoever that the liberals of the Democratic Party want to move to the center?
I don't think that's something that anybody should bake in from the far left. I mean, Bernie Sanders has been Bernie Sanders for 40 years, so I don't see that change. I do see the far left getting louder. And there's some fracture there as well. When you think about a senator like Fetterman out of Pennsylvania differing with maybe some of the more quintessential far left folks that you would think of with AOC or Bernie Sanders, there's just a lot of divide, I would say, in the Democratic Party.
And is there not a belief within the Democratic Party leadership that the left wing of the party is weakening perhaps the overall Democratic Party? And if to any extent they want to be competitive in 2 years, that they need to move more to the center? Is there not a belief there?
Yeah, no, absolutely there is. I mean, but man, how long have we been having that fight? When Democrats were, upset at Bernie Sanders for running against Hillary Clinton, it was the exact same conversation. And that was way back in the day. So it's not that Democrats don't have the same fights that they've always had. They're just still warring factions. And I think what the problem might be from the establishment front with the Chuck Schumer wing of the party is that they're seeing the current dissatisfaction with Donald Trump translate out into the ether and the general public. And Democrats in special elections, as I think I pointed out a couple of weeks ago, are up 10 percentage points more than they were just in November. So it's almost like the work of uniting the party or getting the party excited to turn out is happening in spite of or because of or as a secondary function of this conversation. So they're not overly concerned.
Great first brief of the week. Henrietta Trace, thank you so much from all of us at Team Surveillance. Really, really appreciate it. With Veda Partners.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Talking about United Airlines and, the lounges and all that. Let's talk to somebody who actually knows what they're talking about. How dare we do that? Out of Dartmouth and Tuck, Stephen Trent joins us for Citigroup, iconic on the airlines this morning. Robert Crandall once told me that the revolution was persistent cash flow. Are the bigger United States airlines, are they finally delivering persistent cash flow?
Great question, and thank you for having me on. I would say post-pandemic, the network airlines are doing a very good job of that. United, Delta, American, Alaska, the four of them last year had several $1 billion worth of free cash flow.
I'm Paul. I'm looking at, granted, the pandemic got in the middle of this. I've got them some stack. United's killing it. 10-year track record, 3.4% per year.
Yeah.
Shareholder return.
Talk to us, Stephen, about what we heard from the airlines, I guess, a couple of weeks ago in front of a investor conference. We saw the majors take their forward guidance down. Talk to us about what's driving that. What are they seeing?
Yeah, absolutely. So you do have some issues in terms of where people are trying to get their heads around the economy. Are we going to have a slowdown or not? Are we going to get sort of coherent statements from Washington which give consumers and investors confidence or not? So some of the noise we're getting on that level may have indeed bled at least short term into the booking curve. But I think beyond that as well, unfortunately, you had 1Q is a tough quarter. You had several, unfortunately, high-profile aviation accidents. Several of them were fatal, sadly enough. And then where there's already a tough period for 1Q, we had California wildfires in January. So the confluence of those factors certainly weighed on what happened in short-term guides. Going forward in terms of getting to some calmer waters here, fundamentally speaking, we're constructive.
Where are the airlines in terms of capacity? And how quickly can they move capacity if the economy were to weaken?
Sure. So if one looks at domestic capacity per se, looking at the entire group, we may have kind of a flattish to slightly up picture. In terms of how quickly this stuff can get moved, we already went through sort of a mini review of this last July, when on a short-term basis there was a little too much capacity relative to demand. 3 months or so of that situation, and there was enough of a pull down that we got that nice inflection point in domestic unit revenue in September. So they can move fairly quickly. What's sort of hard to sort out at this time, is what will happen from the perspective of the economy. Do we get a slowdown, or is this just a hiccup?
Stephen Trent with us with Citigroup right now in the airline business. How do you respond to the question, they're really a bank with frequent flyer miles and all the marketing and the dumb lounges, that happens to fly an airline? How do you respond to the financial side of the business versus moving bodies?
Yeah, that's a great one. I would argue that the model has evolved. So if you look at the airlines 20 years ago, doing the credit crunch, for example, Delta Airlines was doing just over $1 billion of loyalty and co-branded card revenue, for example. Now they're doing several $billions a year. So I'm not saying that these businesses have suddenly become card companies or they're consumer companies, but that free cash flow contribution is now significant versus what it used to be. And that will play a role in valuation and earnings quality. So, we think that it's a good thing that they've moved in that direction.
United, American, Delta, the big three. Do investors differentiate between the three, and if so, on what basis?
Yeah, absolutely. I think traditionally Delta's been the gold standard of the trio, the one that people look to management, look to the earnings stream, the strength of its co-branded card. I would say United has moved significantly in that direction. American Airlines was a little bit more of a high beta play. And we've seen some strategic changes from American over the last couple of years. I think the most recent one is really a good move in the right direction for American, re-engaging with managed business travel.
I want to get you in trouble with compliance. Where's JetBlue in 5 years? You got a neutral on JetBlue? Yeah, I believe. Where's JetBlue in 5 years? Help me.
Yeah, absolutely.
Lisa's paying attention.
I would say that in terms of where that carrier moves, the unit revenue side of the fence and the route strategy is sort of one piece of the picture where it looks like they're moving in the correct direction. I would say the piece of the pie that looks a lot more challenging for them is the balance sheet.
Are you going to pay $1,400 for a lounge to get a free gin and tonic?
No, I won't. I won't do that.
Is the whole lounge thing done?
You actually had some post-pandemic chop in all the lounge stuff when everybody started flying again, and you had a lot of people with frequent flyer status who were flooding lounges. So that's a great signal in terms of demand, but some of that has to be sorted a little better. And I think some of the airlines have already started to do that. So I think people still like the lounges.
I got 20 seconds. When you were at Dartmouth, did you fly into Lebanon? You feel like you landed on a Caribbean island.
Yes, my goodness. I did fly into Lebanon a couple of times.
Kim Pruitt was sitting on my lap. Stephen Trent, thank you so much. Really appreciate it. With Citigroup, just definitive here. Lots of green in the screen buys. He likes United and American Airlines, I believe you mentioned as well.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The newspapers, Lisa Mateo. Lisa, what do you have?
Okay, so next month the White House hosts the annual Easter egg roll, right? All the kids come out. It's a big 147-year tradition. But the New York Times is saying this year it could be a little bit different because it could be funded by corporate sponsors. So that's the difference. But they're saying, though, it's raising some ethical, legal concerns from President Trump because he's allowing companies to profit from the event. What are we talking about? How much, right, could a corporate company bring in? So they're saying there's three options. It costs between $75,000 and $200,000. That's what they would pay for the little perks.
To what?
Okay, so for example, they get the corporate booth, they get the logo placements, they get the branded snacks, they get to have exclusive tickets to brunch with the First Lady. They get 150 tickets themselves for the event.
Does the Easter Bunny come in a Cybertruck?
I don't know, but it's a different kind of feel to it, I guess it could be if it brings in these corporate sponsors.
Next.
Supposed to be focused on the children.
Let's raise a little cash, I guess.
Raise a little cash. Yes,
All
it
right.
goes to the White House Historical Association. So there you go.
Sure.
All right. Paul, Sunday Duke, right? Pounded Baylor, 89-66. No doubt they're a good team. But the Washington Post is saying a big reason behind their success is this age-old strategy, their height.
Yeah, the tallest team in the country.
Yeah, the tallest team in the country. 79.8 inches across 15 players. So it ranges from a 7'2" center to a 5'8" guard. Yep. So in between, they have no other player listed below 6'5". I mean, it's crazy the height that they do have, but it's an advantage.
Okay, dumb question, Paul. You're qualified. Okay, should they raise the hoop?
Nah.
11 feet, 12 feet?
No, if they do anything, and they might push back to three-point line at some point. Yeah, but they'll start in the pros there for that. But so Duke is the tallest team. But they're also, I think, and they're probably ranked third in terms of defense, but they're the best defensive Duke team I've ever seen.
I mean, moment of silence here. You've nailed this.
Yeah, they're just
Why
crazy.
does your bracket show your brilliance?
I have no idea exactly, because I tried to get cute, but I should have just picked all the higher seats.
You got to be dumb as wood like me and Lisa.
Yes, you got to do the
A guy emailed in. He says, too much bracket talk. I'm like, we've lost so much money in our 201ks. We're talking bracket. Next.
All right, we go from 201k, we go to Roth IRAs. That's what we're talking about. This is actually the new trend with young savers. Roth IRAs, okay, the Wall Street Journal is saying they're taking the advice of their parents, financial coaches, tax advisors. They're using it to save for retirement, big purchases. They're actually opening it in addition to saving for the workplace retirement plans. So that's something a little bit different. But with TaxSafe not far off, they're actually making all these last minute contributions to it too on top of it. So we're talking about people 40 and under. That's who's starting to use this a little bit more, and they're seeing the advantage.
I think my three oldest kids, they're between 25 and 29. They
do both?
Well, all I'm thinking is, specifically my two older ones, they were little kids. They remember 9/11 because they were preschool 9/11. Yeah. They remember the financial crisis big time, and then they have the pandemic. Their whole life, they've had crazy stuff happen, and I think that's made them a little bit more cautious in terms of saving. That's the conversations I have with my guys, and they're all 401ks and doing all that kind of stuff. And
folks, from Paul Sweeney, there's a single smartest thing I've heard in 90 days. Here, our kids are different, and one of the things is they've seen family members or friends, parents run out of money. That's something we didn't really know.
Yeah, it's different.
Absolutely brilliant. Thank you, Lisa. I just can't say enough about the value of the newspaper segment as well.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.